What if Wall Street was never truly American? What if the banks we trust, the markets we praise, the free economy we celebrate, were quietly owned, steered, and guaranteed by a system no voter ever approved? You've heard the headlines: record profits, new highs, the invisible hand of the market. But behind every surge and crash, there's another hand, one that doesn't gamble. It designs the game itself. In 2008, families lost homes. In 2020, markets soared while jobs vanished. And today, as inflation eats away at every paycheck, someone still collects because the losses of millions are built into the profits of a few. Who actually owns Wall Street? Not the traders, not the banks, not even the billionaires whose names fill the Forbes list. It's deeper, older, and deliberately hidden. This isn't about politics or partisanship. It's about control, financial, psychological, and generational. Where are you watching from? Subscribe for the unfiltered truth before the next crisis decides your future. They tell us the story begins with progress, the age of American finance. 1913, the creation of the Federal Reserve System, supposedly to stabilize the economy after a century of panics. Sound familiar? A system built to prevent crises, yet every generation since has faced one. 1929, 1973, 1987, 2000, 2008. Each crash more complex, each rescue more expensive. In textbooks, it sounds noble. The Fed manages interest rates, regulates banks, and ensures liquidity. But here's the hidden version. The Federal Reserve isn't federal. It's a hybrid network of private banks granted public authority. Its 12 regional branches are technically owned by the very institutions it supervises. When the Fed issues money, it doesn't print it for the public. It lends it to banks with interest. Debt becomes the foundation of currency. Over the decades, Wall Street realized it didn't need to create wealth. It could control credit. Every mortgage, every student loan, every deficit became part of the same machine. And when the machine breaks, the same hands that built it are paid to fix it. Sound familiar? 2008, too big to fail. 2020, quantitative easing. Each rescue prints trillions, not for you, but for balance sheets too big to imagine. 1971, President Nixon untethers the dollar from gold. The Nixon shock, sold as temporary, becomes permanent. No longer backed by anything tangible, the dollar turns faith-based, a promissory note on belief itself. Sound familiar? Temporary measure, they said. Half a century later, that temporary act powers the largest debt cycle in history. When foreign nations protested, the U.S. forged the petro-dollar system. Oil would be traded only in U.S. dollars, forcing every nation to hold American currency. In return, military protection. A world economy born not of trade, but of dependency. Fast forward to today. From the Fed's vaults to the skyscrapers of Manhattan, every trade and bailout traces back to the same circle. And the irony? Most of the owners never appear in public. When a few institutions control both debt issuance and rescue policy, capitalism becomes choreography, not competition. In plain words, Wall Street doesn't respond to the market. Wall Street is the market. Here's where the illusion fractures. The world believes Wall Street is an American icon, patriotic, domestic, independent. But the data says otherwise. According to the Bank for International Settlements, headquartered in Basel, Switzerland, by 2022, more than $630 trillion in derivatives contracts flowed through a few global intermediaries, many tied to the same investment conglomerates that hold majority stakes in Wall Street's largest banks. These aren't simple investments. They're contracts on contracts, bets stacked on illusions. And behind them lies the structure that really owns Wall Street. It's called the derivatives market, the hidden backbone of global finance. No instrument in history has concentrated more power in fewer hands. One miscalculation can erase nations, but one insider can profit from collapse. The custodians of this system? Not elected, not televised. They sit on clearinghouse boards, IMF committees, G20 panels, whispering rules before the world even reads them. You won't believe the name behind this, but to understand it, we have to look deeper into the mechanism that makes all of this possible. If you thought the last part was wild, wait until you see this. We uncovered how the Federal Reserve's independence built a debt-based system, but that was just the surface. Now we're diving into the shadow network that truly owns Wall Street, the derivatives machine. A derivative, simple in definition but devastating in power, is a contract whose value derives from something else, a stock, bond, currency, even the weather. Once a tool for farmers to hedge risk, it evolved into the ultimate weapon of leverage. By 1998, global derivatives totaled $80 trillion. After 2008, that figure exploded. By 2023, estimates ranged from $600 to $1,000 trillion. Each contract creates profit without ownership, power without visibility. A single megabank may hold hundreds of trillions in positions, appearing safe only because the risk is buried in accounting shadows. When Lehman Brothers collapsed, it wasn't mortgages that broke the world. It was derivatives exposure. The hedges became bombs. And who saved the system? The Federal Reserve, funneling $16 trillion through secret central bank swap lines to keep the web alive. That's the hidden ownership, the system sustaining itself through debt too vast to unwind. If a few clearinghouses, ICE, LCH, CME, handle 90% of global trades, and their biggest shareholders are the same funds controlling JP Morgan, Goldman, and BlackRock, then who really owns whom? It's a financial Ouroboros, a serpent devouring its own tail. Even BlackRock and Vanguard, titans of passive investing, are cross-owned by the same funds they manage. Circular power disguised as diversification. By 2022, 3 asset managers controlled $20 trillion, equating to America's GDP. Their interlocked stakes give them voting power across thousands of companies and influence over governments themselves. Wall Street became a feedback loop, profits generated by dependency. Each rescue consolidates more control. 2008 bailouts, 2020 stimulus, 2023 bank failures. Different headlines, same direction, upward. Meanwhile, as people debate inflation and wages, the real game unfolds in silence. Collateralized swaps, synthetic debt, algorithmic trades no regulator fully understands. Power hides behind complexity. The less the public grasps, the more control the structure keeps. Wall Street's real owners aren't CEOs. They're the contracts that bind them. A lattice of obligations so dense that no one can leave without collapse. Too big to fail has evolved into too connected to stop. Let's follow one modern chain. A pension fund buys treasuries, used as collateral in repo trades, linked to derivatives hedging inflation, insured by credit default swaps, backed again by the same treasuries. One loop, infinite leverage. And who clears these trades? The same few clearinghouses, owned by the same few firms. Profit privatized, loss socialized. Regulators turned counterparties. The Bank for International Settlements, born in 1930 to manage war debts, now sits atop the entire structure. Its meetings are secret, its decisions global. Mortgage rates, stock values, and government budgets bend quietly to its signals. And derivatives guarantee obedience. If any major player defaults, the dominoes take everyone down. It's financial, mutually assured destruction. Ownership is an illusion. You own your savings, your stocks, until a single liquidity event rewrites the rules overnight. Ask Cyprus 2013, Argentina 2001, or anyone who faced a frozen account mid-crisis. Global finance isn't democratic, it's algorithmic. And the owners of Wall Street? They're the beneficiaries of that code. Their product? Confidence. Their currency? Debt. Their weapon? Opacity. As long as people believe their money is safe in the market quietly owns them. So, who actually owns Wall Street? Not a person, not a country, but a self-perpetuating system of derivative obligations and central bank guarantees so vast that ownership has lost meaning. 1929, greed caused collapse. 1971, power changed form. 2008, illusion became policy. Now, digital control replaces both. The next crisis may not involve a crash at all. It may begin with code, a liquidity freeze, a CBDC trigger, a silent balance reset. Central bank digital currencies promise convenience, but behind every digital wallet lies surveillance, programmable access, instant compliance. Money becomes a switch,